In March 2023, $42 billion tried to leave one bank in a single day.
Most of the money in our economy isn't really real. Not in the way you probably think it is. It's not printed by a mint or locked away in some vault. No, it exists mostly as a digital ledger, a huge, invisible system built on promises. And we're going to dive deep into this system, this world of ghost money, to find out what's really holding it all together.
Think about your bank account for a second. That number you see on the screen, it feels solid, right? It feels tangible. But here's the kicker. The physical cash out there, the actual bills and coins, that only makes up about 3% of all the money in the system. The other 97%? Well, that exists purely as digital bank deposits. It's the main form of money in our world today. So, where on earth does it all come from?
Well, the answer might surprise you. Most people assume, pretty logically, that the government or the central bank, like the Federal Reserve, creates all our money. But that's not how it works. In reality, the vast, vast majority of it, that entire 97% we just talked about, is created by commercial banks. Yeah, I'm talking about the very same banks where you have your checking and savings accounts.
So let's get down to it. What even is a bank deposit? I mean, fundamentally, it's not a little pile of your cash that the bank is holding for you in a safe. No, it's actually a liability on the bank's books. Think of it as an IOU. It's a digital promise from your bank to you saying, we owe you this much cash whenever you ask for it. The entire global financial system, literally the whole thing, is built on top of these digital promises.
And this, right here, completely shatters a huge myth about how banking works. You know the old textbook idea that we all learned in school, that banks are just middlemen, right? They take in deposits from savers, and then they lend that same money out to borrowers. It sounds simple, it sounds logical, but it's wrong. The modern reality, and this is confirmed by central banks themselves, is the complete opposite. Banks don't lend out money that already exists. The very act of lending creates brand new money.
And how they do it is, well, it's surprisingly simple. When a bank decides to give you a loan, say for a car, they don't go and check their vault to see if they have the cash. Nope, they just type a number into your bank account. They credit your account with a new digital deposit. And just like that, two things happen on their balance sheet. The loan is a new asset for them, and your new deposit is a liability. In that single moment, poof, new money has been created.
Okay, let's just walk through a real-world example. Imagine a family gets approved for a mortgage to buy their first home. The bank doesn't move a pile of cash from its reserves over to their account. All it does is type a number, say $300,000, into the family's bank account. That digital entry, created with a few keystrokes, is brand new money. And look, this isn't some bug or flaw in the system. This is literally how our financial system is designed to work. And just as lending creates this money, paying back your loan actually makes that money disappear. It destroys it.
Now, the sheer scale of all this digitally created money it's staggering. If you look at something called the M2 money supply, which is basically a broad measure of all the money out there, including cash and these digital deposits, you can really see the impact. In just 2 years, right through the pandemic, it absolutely exploded by more than 6 times trillion dollars. And let's be clear, this wasn't all just newly printed cash. It was a massive expansion of those digital bank deposits, all driven by policies that were designed to pump up bank lending.
But when you see numbers that big, it really highlights a critical vulnerability, doesn't it? I mean, if most of our money is just a collection of digital promises from private banks, then the entire system, the whole shebang, is resting on just one single thing: confidence. Our belief that the promise is good. So, what happens when we stop believing? What happens when that confidence suddenly shatters?
Well, in the spring of 2023, we got our answer: the collapse of Silicon Valley Bank. Look, this wasn't just another bank going under. It was a powerful real-world demonstration of just how fragile our modern digital financial system can be.
The speed of it all was just unprecedented. Think about this timeline. On March 8th, SVB announces a huge loss. By the very next day, March 9th, panic, supercharged by social media, is spreading like wildfire. And by midday on March 10th, it's over. Regulators step in and seize the bank. A $200 billion bank, just gone. It evaporated in less than 48 hours.
Let's just try to wrap our heads around that speed for a moment. On March 9th, in a single day, depositors tried to pull $42 billion out of the bank. That's about a quarter of all its deposits in one day. And this wasn't the black and white photos you see from the 1930s with people lining up around the block. No, this was a modern bank run, executed with a few taps on a smartphone and a couple of clicks on a wire transfer.
And really, that's what made this whole thing so different.
Experts immediately started calling it the first Twitter-fueled bank run in history. You had venture capitalists, tech founders, all in this tight-knit online community, creating this massive echo chamber, just spreading fear instantly. The digital nature of the ghost money was perfectly matched by the digital speed of the panic. Confidence wasn't lost over days or weeks, it was absolutely obliterated in a matter of hours.
So why SVB? Well, it was really a perfect storm of problems. First, they had completely mismanaged the risk from rising interest rates. That left them sitting on a mountain of hidden losses in their bond portfolio. Then, and this is critical, over 90% of their deposits were uninsured. They were way over the FDIC limit. And to top it all off, almost all their customers came from one single tightly networked industry, the tech world. So when one person got spooked and ran for the exits, they all ran together.
Just to put this into perspective for you, this was the second largest bank failure in the entire history of the United States. It was bigger than nearly anything we saw during the massive financial crisis back in 2008. But here's the key difference. Unlike 2008, this crisis wasn't unfolding in slow motion. It was happening at the speed of light.
And of course, that fear proved to be contagious. It started to spread. Just 2 days after SVB went down, Signature Bank collapsed. Then all eyes turned to First Republic Bank. The panic was jumping from bank to bank. The ghost money system was teetering on the edge of a full-blown meltdown, threatening to drag the entire economy down with it.
This was the moment. This is when the creator of the last 3% of our money, the central bank, had to ride in to save the creators of the other 97%. The Federal Reserve had no choice but to step up and act as the ultimate backstop, the lender of last resort for this entire system of promises.
So on Sunday, March 12th, the Fed rolls out a brand new emergency program. It's called the Bank Term Funding Program, or BTFP for short, and its goal was incredibly simple: stop the bleeding, stop it now, and restore confidence in the system immediately.
And here's where we get to the really critical part. Normally, when a bank borrows from the Fed, they have to face reality. They can only get loans based on the current market price of their assets, which in this case had crashed. But the BTFP, well, it created a whole new reality. It let banks borrow money against the original price they paid for their bonds, their face value. It essentially allowed everyone to just pretend that those huge, massive losses on paper didn't exist. This was the magic bullet. By making a credible promise to lend against these underwater assets at their full original value, the Fed made the entire solvency problem just vanish, at least on paper. The simple announcement of this incredibly powerful backstop was enough to calm everyone down. It restored faith in the ghost money system, all because the Fed promised to create basically unlimited liquidity if things got worse.
So where does that leave us? It brings us right back to that fundamental question we started with. Now that we've seen how this ghost money is created out of thin air, and we've seen just how fragile that system really is, what is the money sitting in our bank accounts?
All right, let's just recap the big takeaways here. 1. Most of what we think of as money is really just digital debt, an IOU created by private banks when they make a loan. 2. This whole system is built on confidence, and as we saw in 2023, the confidence can evaporate in a matter of hours in our digital world. And 3, when that confidence does shatter, the only thing standing between us and a total collapse is the Federal Reserve, ready to step in and create whatever liquidity is needed to hold it all together.
And that leaves us with one final, lingering question. What does it actually mean to have money in your bank account? Is it a real, tangible asset? Or is it just a shared belief, a collective confidence in a digital IOU that's only held stable because we know that in a real crisis, an even bigger IOU from the central bank will be created to back it all up? The ghost in the machine, it turns out, is a ghost we all have to believe in together.
In a world of ghost money, the only real asset you have is whether the system believes you.